Welcome to this optional video on bond pricing. In our class, when we're given information about when we're accounting for bonds payable, specifically those bonds that are issued at either a discount or a premium, we'll be given the issue price, or in other words, we'll be given the present value of the bonds. So we don't need to calculate the present value. But you might be curious, where does that present value come from? Let's take a look at this example here. Service Master Company issues $100,000 in bonds, due in 5 years with a 9% interest payable annually at year end. So this 9% rate, this is the stated rate, or what we call the coupon rate. So each year, and most bonds pay interest semi-annually, but in this case, for simplicity, we're making the interest payment annually. Each year, the bondholder is going to receive 9% of 100,000 or $9,000. At the time that bond was issued, the market rate for similar bonds is 11%, and the bonds were issued or sold for $92,608. So again, this is an optional video because the $92,608 issue price or present value or the value of the bond on the day that it's sold or issued to the market is given to us. But let's take a look at where the $92,608 comes from. Here we see a timeline that shows the cash flows for Service Master. Now, forget that we know the present value or the amount of cash that Service Master is going to receive when they issue bond today times 0. What we do know is that the company is going to have to repay $100,000, repay the principal at maturity, and the company is also going to have to pay $9,000 as interest each year at the end of each year because this is an annual bond, and that $9,000, of course, is the $100,000 face value of the bond multiplied by the stated interest rate of 9%. So what is this bond worth today times 0? We need to discount the $100,000 back 5 years. We also need to discount each one of these $9,000 interest payments back to today's dollar terms. Let's take a look at that step by step on this next slide here. Once again, we need to discount the $9,000. So if we're looking for this, the first payment that's going to be made by Service Master is this $9,000 interest at the end of year 1. And how do we discount that back to today's dollar terms? We take the $9,000 divided by 1 plus the discount rate, which is 1 plus, and now when we're using the discount rate, remember we're using the market rate. And we're going to put that to the exponent of the number of periods that we're discounting back. So we have the cash flow, 9,000, divided by 1 plus the interest rate. Where this interest rate are, we use not the coupon rate, but the market rate. And in this case, it's 11%, as we see here. But we can't stop there. And in this period we can, but in future periods we can't. We're going to put that denominator, let me fix this, put just that denominator, 1 plus r, to the n, where n is the number of periods we're discounting. So in this first period, we are going back 1 year, so our exponent is 1. 9,000 divided by 1.11. Today, that would be worth, or in other words, if we said this just in plain English, the value of 9,000 to be received 1 year from now at a rate of 11% would give us $8,108 today. Or if I invested $8,108 today in an account that offered me 11% annually, in 1 year I would have 9,000. So what we did is we just found the present value of the first interest payment. To find our total present value, we need to add in the present value of all of these interest payments plus the present value of this principal payment at the end of the 5 years. What is the value of the second principal payment of 9,000? Well, 9,000 divided by 1 plus the interest rate, 1.11, to the exponent of 2 because we are discounting back 2 years. So 9,000 divided by 1.11 squared gets us a present value, the value today, of 7,305. Let's do the same thing for that third cash flow. 9,000 divided by 1.11 to the third. This gives us a value today. So if we received $6,581 today, and we invested it at an annual rate of 11%. In 3 years, that 6581 would turn into 9,000. Let's do that for our fourth cash flow. 9,000 discounted back 4 periods, 4 years. That is worth today 5,929. And finally, our last cash flow is the sum of the principal payment and the last interest payment. So for that last cash flow, we're discounting 109,000, 1 plus the interest rate of 11%, remember we use the market rate, to the power of 5. We're discounting back 5 years. And the value of that today, the present value, is 64,686, or in other words, if I invested 64,686 today at an annual interest rate of 11%, that would turn into $109,000 5 years from now. So if I add all this up, the present value of each one of these cash flows, I get a total present value of all cash flows, $92,608. This is the bond's price today. Now we can also solve for the bond's price. Remember, what we're doing here is present value. When we think present value, typically we're thinking about Excel. So let's take a look at calculating the present value of the bonds at its issuance date using the Excel function rather than calculating the present value of each individual cash flow and then adding them all up. So we're going to use the present value function equals PV. We're asked to put in the rate on the bonds. Remember, we're going to use the market rate, which is 11%. This is an annual rate. There's 5 annual periods. The payment is the payments that are going to be made on regular occurrences, which is going to be the interest. The interest is the face value of the bond, 100,000, times the stated interest rate of 9%. So the company is going to pay out $9,000 each year. The future value of the bond at the end of the life of the bond, the company is going to have to pay out $100,000. Payments are made at the end of the year, so we're going to put type 0. And let's look at what the present value is going to be, 92,601, same as we got when we did the present value of each individual cash flow. There's a third method that we can use to determine the present value of the bond at the date of issuance, and that is to use the present value factors from a table. We would start by taking the $100,000 principal that's going to be repaid in 5 years and find what is the value of that $100,000 today based on present value factors. We can come up to a table like this where we find present value of 1, the number of periods is 5, and the interest rate is 11%. So we scroll down here, 11% at 5 years. We take the 100,000 to be paid out in 5 years and multiply it by 0.59345. And we see that here. We get 59,345. We add to that the present value of receiving 5 annual interest payments starting in year 1, continuing through year 5. So that we would take the present value of an ordinary annuity because their payments are made at the end of the year. We would find the amount from the present value factor table. Here we have present value of an ordinary annuity, interest rate 11%, number of periods equals 5. So we would use 3.6959. And that's what we see here, 3.6959 multiplied by 9,000 gives us present value of all of the 5 interest payments of 33,263. We add up the 2 present values we've just calculated, and we get the present value of the bonds. Again, this was all just optional. In each of our examples, we're going to be given the present value or the issuance price, selling price of the bonds. But this helps tie together the concepts that you've learned in your finance classes, particularly corporate finance and financial management, to what we do in intermediate accounting.